It's Daryl, and grateful to be here.
Hey, Daryl.
Certainly have benefited from the insight, and I've already ordered the book. But I have a question with regard to savings.
Yes.
And what I'm looking to understand is there a heuristic around incorporating savings, or is that based on, I guess, an individual savings goal? And I just asked that in preparation for my wife and I building a home and just kind of looking forward. Savings is kind of big and it's a goal for her. Getting out of debt, so to speak, is a goal for both of us. But I'm really just trying to revamp the way we're thinking about it from the insight that you share on here ongoing.
Wow, Daryl, that is a great question in terms of savings. Now, that conjures up different types of savings. Tell us what you mean by savings, because I think I know where you're going. I'm getting all excited just thinking about it.
Hopefully, what I say is not anticlimactic then. Really, we don't have good experience with savings in the past.
Mm-hmm.
So I would say, emergency savings, just really beginning to save well, just generations of debt and working in that way, just trying to establish a basis of healthy savings.
Ah, okay. So then you're not talking about long-term savings like retirement savings, like a 401k with your job and everything. You're talking about like emergency funds that you keep in the bank. Is that what you're talking about, Daryl?
That's correct.
All right. So here's my thought on that. All right. So what we're going to do, I've got to change screens now. We thought we put one thing up, but we're going to put another thing up instead. So let's go ahead and share this instead. And I think you're going to like what you see here, sir, when we talk about sharing this idea. All right. So we're going to be talking about what a lot of the financial gurus teach in terms of keeping funds on hand just in case your income becomes affected. And you want to have 6 months of income or 6 months of your monthly bills saved up, 6 months to a year even, saved up just in case you have an emergency, and you can use cash and not borrow to facilitate your living while you are recovering or getting back into a new job. Okay, so here's what we've got. I'm having this same conversation with a banker who's a junior vice president in this bank about this very thing. So let me go ahead and put that in here. We're going to get rid of this. All right. So he's saying, based on how much money I make, and this was some years ago, I'm sitting in his office and it came up that I want to put $36,000 away just in case my wife can't work or I can't work so we can continue to pay bills. Is this what you're talking about, Daryl?
Yes, sir.
Okay, so here's what I asked him. I said, now, let's take a look at your mortgage. You could easily put $36,000 away based on what you're making. I said, do you want to pay tens of thousands of dollars, sometimes 60, 70,000? Do you want to pay 50, 60, 70,000 just to keep from paying $5,000? So I'm going to ask it to you, dear. What if you heard that? Do you want to pay $50,000 or $60,000 just to keep from paying $5,000? What would your answer be to that?
I would not want to pay more.
Yeah, you would not want that scenario. So let's take a look at this. So this gentleman who could put $36,000 away, I said, now what if instead of taking that $36,000, because you would want access to it, you would want it liquid, so you would want to put it in some sort of bank account so you could access in times of emergency. Okay, so by doing that, let's say you're putting in a bank account that's making what, 0.1%. Okay, so let's take a look at that. Now, if you take a look at this loan here, you can see principal, interest, cumulative principal, and cumulative interest. This is something like his loan, but it's not exactly like, because we want to protect someone else's information. So this is not exactly this person's loan, but it's close to it. Okay, so here's what I want you to see. If we take a look at this, we can see how much principal we pay down and interest we pay off in a year. So in 1 year, he's paid this loan down by $7,924.68, and it costs $17,000 in interest to do that. Let's take a look at $36,000 $36,000. Let's see. Here's where we get right about $36,000. If you were to put $36,000 prepaid on this loan, okay, instead of just sticking it in a savings account, it knocks off over 50 payments. Okay, that's 4 years. Okay, 48 months. That's 4 years off the mortgage. And look here, how much interest does he save at the $35,000 level? About $70,000 is what he would save. All right. And then I asked him, I said, now, since you are at the bank, could you get a line of credit for $36,000? Well, actually, at $36,000, that puts us at $73,000 in interest. It could knock off $73,000 in interest. So here's what I asked him. I said, could you get a line of credit for $36,000? He says, well, sure, I could. Yeah, I could get a line of credit for $36,000 because I work at the bank. And I said, if you got a line of credit like a HELOC, home equity line of credit, how much interest are you paying on that money? The availability of that money. He says, I'm not paying any interest on that because I haven't borrowed anything. I just have it available to me. I said, now, let me get this straight. You have $36,000 available to you that is not costing you anything for an eventual emergency that may never happen. He says, well, yeah, yeah, 36,000 available just in case something bad happens, but chances are it will not happen. But if it does, I have it. It's there for the ready. And I said, let's just say if you put that $36,000 on your mortgage and you knock off 4 years and save yourself over $70,000 in interest, would that be a good thing for you? He says, well, yeah, that would be a great thing for us. I didn't realize he's working in a bank. He didn't realize that putting this kind of money on the debt would knock off so many years and save so much interest, over $70,000. And I said, now let's take for granted that something happens and you can't work for a while and you have to borrow every single dime of that $36,000. Now, I know you could put it away easily. And let's say you had to borrow all of that and then you go back to work. So you go back to work and now you got to pay back the 36 grand. And this is why people don't want to borrow the money, because they have to pay interest on the money borrowed. So let's take a look at that. We're going to go over to here. We're going to put in $36,000 into this amortization schedule, 36,000. We're going to give him 5 years to pay it back. He could pay it back easy, but I'm going to give him 5 years to pay it back. Okay. 5 years to pay it back at a whopping 6% interest. Okay. Watch what his payment is going to be. He could easily make that payment, $695 a month. Here is what I was talking about. Look at the total interest cost of paying back the borrowed money, ladies and gentlemen, right here, $5,758.80. Now back to my question. Do you want to pay $70,000 on your mortgage to save that cash in a bank account making 1/10% to avoid paying interest on a loan that would do the same thing for you, and the interest amounts to $5,700? Do you want to pay $70,000 to avoid paying $5,700? Do you see what we're talking about, Daryl?
Absolutely.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.